Hi everyone. So today we would be discussing around Indas to inventory. So it's a very easy topic. So here we would be discussing around the objective, scope, measurement principle, recognition principle, and the disclosure. So when we talk about the objective, so here we have to understand the accounting treatment of inventory. We have to understand how the cost is determined and how the subsequent recognition is done and which method we used, like FIFO, weighted average, or specific identification cost method, or like what is the measurement of cost, what are the different technique we use, such as a standard cost or the detail method. Then moving to the scope, so it is applicable to all kind of inventory except financial instrument, biological asset, because these are covered by their particular standards. This standard does not apply to the measurement of inventory held by agriculture produce, commodity brokers who measure the inventory at a fair value, less cost of sales. Okay. So when we talk about the relevant definitions, so first important definition is inventory. So inventory, what is that? It's an asset. So which consists of finished good, WIP, and raw material. Finished good are something held in the ordinary course of business or in the process of production for such sale. We call it as WIP. Raw material which is consumed in the production process or rendering of services. So if we talk about inventory encompass of, so it's the same: raw material consumed, finished good produced, and material supply awaiting use in the production process. So here is an illustration which speaks about, as per India's 2, inventory include material and supply awaiting use in the production process. Examine whether the packing material and publicity material are covered by the term material and supply awaiting use in the production process or not. So if we look at the solution, so it is saying that the primary packing material will be included within the scope of the material and supply awaiting use in the production process, but the secondary packing material and publicity material can't be included, as these are the selling costs which are required to be excluded from the Ind AS 2. For this purpose, the primary packing material is the one which is essential to bring an item of inventory in a saleable condition. For example, bottles, cans in case of food and beverage industry. Other packing materials which are used for transporting and forwarding the material will normally be a part of secondary packing material and will not be form part of Ind AS 2. Now there is a concept called net realizable value. So net realizable value is the estimated selling price in the ordinary course of business less estimated cost of completion and estimated cost necessary to make the sale. Net realizable value refers to the amount that entity expects to realize from the sale of inventory in the ordinary course of business. There is also a concept called fair value. Fair value is the price that would be received to sell an asset and paid to transfer a liability in an ordinary transaction between market participant. We have a separate Indias which called 113, where we will discuss more uh, detail about the fair value. So here is an example which says an entity holds inventory of 10,000 unit and it could sell the same in the market for 10 each. The entity has an order in hand to sell the inventory at 11. The incremental selling cost per unit is 0.5 per unit. And in this situation, fair value is 10 each. What is the net realizable value? So it is the 11 minus 0.5, that comes to 10.5. Okay. So what is the difference between net realizable value and the fair value? So NRV refers to the amount that an entity expects to realize from the sale of inventory, and it is entity specific value. But when we talk about fair value, it is an orderly transaction to sell the same inventory in principle or most advantageous market. We will discuss in 113 what is principal and most advantageous market. So here the measurement basis is the market based approach. Measurement of inventory. So it's very important to understand this concept. So we should measure the inventory at lower of cost or NRV. So what is cost of inventory? Cost of inventory is all the cost related to the purchase, cost of conversion, all costs incurred in bringing the inventory to their present location and condition. So when we talk about cost of purchase include purchase price, import duty and other taxes, transport handling cost, other costs directly attributable to the acquisition of finished good material and services. Any trade discount related and other similar items are deducted in determining the cost of inventory. Okay, so here is a question which says ABC Limited buys good from an overseas supplier. It has recently taken delivery of 10,000 unit of component X. The quoted price of component X was 1200 per unit, but ABC Limited has negotiated a trade discount of 5% due to the size of the order. The supplier offered an early settlement discount of 2% for payment within 30 days, and ABC Limited intends to achieve this. So here the 5% discount is irrelevant to the question. Trade discount is something which is relevant. So here the purchase price would be 1000 units into 1200 into 95%. That is 11 lakh 40,000. Then it is saying that import duty of 60 per unit must be paid before the goods are released through custom. So what is the unit? 1000 into 60, that is 60,000. It will be added to the cost. Once the goods are released through custom, ABC Limited must pay a delivery cost of